Hello everyone. Today we are going to talk about a subject which could be a bit easier than the previous ones that we have, but not less interesting, definitely. We're going to talk about basics or fundamentals of Forex trading. Forex is one of the fastest growing industries and is quite popular, especially in the past 10 or 20 years. We have witnessed the boom of Forex industry. A number of brokers started their business and developed and doing well, as this is one of the nowadays quite popular ways of making money. Of course, to make money, it will include all what we spoke in our previous classes, meaning that we have to have plan, we have to have discipline, we have to have a detailed analysis, forecasts, predictions, knowledge of the technical and fundamental analysis, all what is needed and necessary to make the successful trades. Otherwise, it's quite possible that we may lose our money. So it requires a lot of work, but at the end will give satisfactory results, what we are looking for, profits in other words. So as we said, Forex is and it's one of the biggest world markets also. Need to mention this. It is it's the largest and the most liquid, actually, the market in the world, and average daily turnover of around $7 trillion US says everything. So there is a huge amount of money turning over every day in the Forex market. So that gives it its popularity and attracts a number of new traders to join and try themselves in this, I would call it very exciting and challenging industry, but which could be also highly profitable, of course, if we follow all the rules, like in any other business. What is Forex? Basically, it's the market where there are several big participants that are inside. We're talking about central banks, about banks, about governments and governmental institutions. We're talking about investors and ordinary traders like me and you come to exchange currencies and basically speculating what will be the future currency movement. So if they expect euro to go higher, let's say, then they will speculate on buying euro and awaiting euro to go higher in order to register the profit and to close their position with the profit. So basically, it's the place where it's a market where everyone who is involved comes to exchange currency rates. There is a diagram which shows all the participants in the Forex market. So we have ordinary traders, we have investment funds, corporations, big companies, central banks, commercial banks. So all together make one big circle, which is basically the base of Forex trading. So they are all involved. The central banks have their own reasons of exchanging needs, actually, of exchanging money, the same like commercial banks. Similar is the governments, big companies, investment funds that are purchasing or selling some assets in order to multiply the funds that they run, and the ordinary traders, retail traders, they are trying to catch some moves and make some profit, speculating on ascending or descending on of their currency pairs. It's Forex market, as said, is the biggest and the most liquid, and runs 5 days a week, 24 hours a day. It literally follows the sun, as the trading starts at the Far East, actually in Australia, and on Sunday, actually Sunday evening, and continues until the Friday end of the day closing. It's late evening in the end of business of the US session. So it covers whole world, and we have the most important, the biggest, basically trading centers in the world, such as New York, London, Paris, Frankfurt, Singapore, Hong Kong, and Sydney at the end. Or if we turn it vice versa, as the trading starts, Asia is the first one to start in the new day. So it comes from Sydney through Hong Kong, Singapore, then hits Europe, and then goes to United States, where the circle closes for each trading day or trading week. So it's a quite interesting and dynamic market, and it's a product that is quoted by all major banks. You can see in the commercials, in the adverts, in the information simply in the net or newspapers that central banks, the banks are quoting euro against US dollar, British pound against US dollar, dollar yen, or British pound against Japanese yen. What is interesting about Forex market is that is decentralized. There is no central marketplace compared to the, let's say, New York Stock Exchange, which is organized exchange, and every transaction needs to go through them. Forex market is decentralized, so you can buy dollar against Japanese yen, let's say in Sydney, in the Bank of Australia, whatever, and sell it somewhere in the Europe or in States. It's not important. Trades are basically done so-called over the counter, and each bank or each entity that is involved, that is giving the prices, mainly they are banks, they display these prices, and the price continues to fluctuate. So it's very unlikely that you will see exactly the same price within a few minutes from various banks, again depending on the activity, liquidity of the market. But generally, if the market is moving, then the prices will continue moving. If you take a look, even at the same moment, the prices might not be exactly the same. Some banks will shift to one, or some banks on the other side, but the prices are still competitive. So any shifting must be done within the required parameters and within the real price. Otherwise, the bank will have problems, and it's basically a problem with the licenses and things, because the price must be fair and honest. So few small parts of one pip to be shifted on one on the other side is permitted. Otherwise, it will not be. But as I said, market is quite active and liquid, and the price keeps moving. So you will not very unlikely to see the same price on all from all price providers. Now we have next step are the brokers. The brokers are companies that basically stand between a trader and the currency pair or price or feed or whatever. So the trader comes to broker, procedure goes, opening account, putting deposit, and the broker is the one that will provide the price. They get price feeds from various banks, and then they create the average price, which is displayed on their trading platforms, and this is what traders get, and they trade this price. You can always compare the price. If you are, let's say, trading with one broker, and you may think that the price is not fair, or it's too high or too low, you can always compare with the other brokers and with the other banks, and you will see that you will not find some major differences, because in order to stay competitive, this is what I spoke just a few minutes ago. In order to stay competitive, you stay in the market. Basically, you have to have competitive prices. So if the traders realize that your prices are not fair or not competitive, they will likely leave you. So broker is the entity that provides all the services for the traders, and basically they are market makers for traders. They provide the price, they provide the price feed. So when you open your trading platform, you can see the various currency pairs or various assets displayed there, and the price keeps fluctuating. So broker must have a proper source of price, not only one, and then they create the average price that is displayed in their trading platforms, and this basically marks the trading price, and this is the price that traders are taking when they make their trading decision. Now we are coming, when we are talking about price, we are talking about exchange rate. So what is exchange rate for euro against US dollar at the moment? I can see on my screen it's 111.46. So for 1 euro you can get 1.11. It's on 4 decimals, so 1.1 and something, let's say, if we want to round it, 1.15, let's say, US dollars. So it means that euro is at the moment stronger than dollar. So there is a so-called parity level when you get one unit of the first currency for when you basically get 1 unit of the second currency for the 1 unit of the first currency. Anything above or below this shows the difference, and this is exchange rate. So in the Forex market, which is the centralized market, as we said, the prices are the values of different currencies are presented, and this is the price that is tradable price, and the traders are taking it for making their to execute their trades. So the exchange rate is basically the value of the currency, one currency in terms of the other currency. So euro against US dollar, we have exchange rate currency at 111.47 at the moment. So this is the current exchange rate of the euro dollar. If you now check various price providers, you may find it half a tick up or down, but it must be around there. Otherwise, you are not competitive, and something is wrong with your price feed. This may not always apply during the sharp moves, when it's quite difficult to catch the move and catch the right price. So we have seen this, let's say, during the crash of sterling after Brexit vote, or even more was obvious during the September 11. During September 11, when the US stock indices simply crashed, and there was a very difficult to catch the right price, and then at the end the exchanges decided to stop trading to prevent a catastrophic scenario which was already developing. So when you have certain events, something that happens and the changes and moves the market strongly within few seconds, then the price feed might vary, may have different values, but generally most of the brokers, in help with today's advanced technology, are trying to filter out all these wrong ticks, so-called noise, in order to get as better as possible price and as better as competitive price. This is the only way to attract traders and keep them with them. So exchange rate is basically the price that first currency against the second currency worth at that moment. The price, of course, continues moving, and depending mainly on the offer and demand. So all these things are pushing the price up or down, offer and demand. Basically, what is how the market moves, we spoke in our previous classes, and we said that offer and demand is also driven by events in the market. If something is happening in the market, like sterling is going down continuously due to Brexit and the turmoil in the UK, political turmoil in the UK regarding Brexit, and all these fears about potential no deal exit from the European Union, which could in a way lead towards could have catastrophic consequences for the UK as well as the European economy, is the nightmare of everyone, and this is now becoming again very actual. And most of traders are aware of this. Actually, all traders are aware of this, and most of them are strongly selling sterling, trying to get rid of sterling. Because why? Because the situation as it is at the moment is unstable. It signals that it could worsen at certain point, and then it's quite risky. And if you are holding sterling, you are losing continuously, because sterling is down continuously. Just during the May, it lost over 4%, and since since March, I think it is down over 5%, only due to the turmoil around Brexit. And now we have story that UK Prime Minister Theresa May is about to resign. There's high pressure on her, and she's about to announce the final time of her day of her resignation, which is likely to be very soon. So when you collect all these data, let's call them data, information in one thing, then you get a picture how it is, and outlook becomes negative for sterling. So we have strong political turmoil when the government is falling apart. A number of ministers already resigned, and some of them are about to resign. So it's a very negative signal. The Prime Minister is going to resign. There is a strong threat that UK may leave the European Union without deal, and this is another strong threat. So building one very negative sentiment, which now we're coming to our main subject, it's increasing offer of the currency. So sterling is strongly offered at this moment and is pushed lower. Okay, there is some correction during the now currently, but it's still mild. The general trend is still down. So every trader that is looking for sterling is looking for some corrective action to as a better selling opportunity to re-enter the market. We talked about trend and following the trend. So what we do, we follow the trend. Some more experienced traders will catch corrections as better trading opportunities. And generally no one will be buying, not at least not until we have certain strong, very strong signal that could diminish current pressure on sterling and current negative sentiment. So until then, they're all selling. So sentiment is negative, and market is so-called bearish as everyone is selling. So strong offer of the currency. It's much bigger than the demand, so it's pushing the currency pair down. Now we're talking about currency pair. It's basically the exchange rate of one of main world currencies against US dollar. So we have major currency pairs such as euro dollar, British pound, US dollar, dollar yen, dollar Swiss franc, Australian dollar against the US dollar, dollar against Canadian dollar. So these are the major currency pairs, and you will find this term very often. And there are another pairs which do not include US dollar. So if we have, let's say, euro against British pound, or British pound against Japanese yen, or euro against yen, or any of these crosses, Australian dollar against New Zealand dollar, they're called the cross rates or crosses. So you will hear this term. So you need to know what is this. So basically we have a currency pair. So it's a first currency against the second currency, and they are classified as a major pairs, which include US dollar, and the cross rates or cross pairs that are without US dollar. So including relation between all other currencies except euro, except US dollar. Now we can see how much was the contribution of each of the major currencies in the world in the Forex market. So we can see that dollar holds a huge portion of the market compared to the others. The second one is euro, and then we have Japanese yen, British pound, Aussie dollar, Swiss franc, and the others. So we have a quite interesting situation. So that's why the US is the biggest, United States is the biggest economy in the world, and dollar is a dominant currency so far in the world. So most of the things, and even currency, even commodities, the price is displayed in US dollar. So the dollar is involved in everything, and you can see on the diagram how much are the other major currencies. We're talking about major currencies of the big economies such as Eurozone, Japan, sterling, Australia, Switzerland are much lower than the US dollar. US dollar holds the biggest part of this, let's call it cake. Now, when we have currency pair, for example, it's British pound against US dollar. Now, first currency, which is British pound, is called the base currency. So based on this, we are looking for the relationship of the base currency or exchange rate of the base currency against the second one. So a base currency is sterling, so we're looking for the exchange rate of sterling against US dollar. So one sterling is worth at the moment 1.2649 US dollars on 4 decimals. So we're talking about 1.265 US dollars. So what does this mean? When you give £1, you will get 1.265 US dollars. Where is this important? Apart from speculating and trying to catch profit on the price difference, there are a number of other needs for exchanging money. So let's say companies from states who are buying something from Japan, for example, they will need to exchange their dollars into yen in order to pay. Or if you travel, let's say, from European Union to UK, let's say, then you will have to exchange your euros into sterling, and to be able to pay things there, unless you use a credit card. So you are looking, everyone is looking for the rate, currency exchange rate to see whether it's good or not. Sometimes we are in a hurry and we must do something, but sometimes we can wait to see a better price. I have a good sample, let's say a number of students studying in the UK, and the parents keep asking me about rate between euro and sterling, because they want to send their kids money and they're trying to catch the best rates. And then I give them my view outlook. If the price is not that good, but has signals that it might worsen, I tell them go and exchange it now, not to risk too much. Or if there is a signal that the price could improve, that euro could further strengthen against sterling, then I tell them wait for a couple of days and then execute your exchange, because you may get some better exchange rate, meaning some more money. Of course, when you exchange small amounts, the difference will not be big, but if we're talking about bigger amounts, then it's quite significant and it's worth waiting. So we have the exchange rate, currency pairs, and behavior now of these currency pairs is, you all heard bull, bear, bullish market, bearish market. So these are the things that you need to know when you read the comments. You can hear, let's say, for today, sterling against US dollar, or so-called cable, is very bearish due to the problems with the Brexit, and has signals that it might extend further down. It's already on the it hit the lowest in 2019, so it's a quite bearish market. So meaning when you say bearish market, meaning that prevailing trend is negative, is down, and we can think only about selling in this case, because we already learned that we are following the trend. So when the prevailing direction is negative, we are going to sell. We are not going to gamble with our money and buy, speculating that what if something happens. We'll leave these two contrarians that are well known, and we already covered this subject in one of our previous classes. So it's important to know when the bullish market, the market is up, the market is positive, and this is signal to buy. Of course, we have to fine-tune our analysis, our decision through analysis and the news and the releases, everything, to get as better as possible information and to catch the best possible price. You need to squeeze the maximum of the market opportunity in order to succeed. But of course, I have to go back again to these important things about analyzing, about trading plan, about trading discipline. These things are crucial, and I'll keep repeating them, because without this, you may have luck at the beginning. I think I mentioned this already, that beginners are always lucky at the beginning. I don't know, it's like a rule. It's something from the, I don't know, higher power that supports them at the beginning. all of them make money at the beginning, but then the problem becomes very obvious and has very negative impact to these traders, because they gain sort of self-confidence which is not justified, which is not something that they achieved through their knowledge, through their work, through something. They just came in the market thinking, I know, I read some articles about this, I saw some charts, that's it, I'm a professional. And then this fortuna that comes to them, the fortune, the luck starts to melt, and then they start losing money. And then they start making mistakes, jumping into selling when the market is bullish, trying to recover in the opposite direction of the market. And this is, again, leading towards the catastrophic scenario. And usually people stay without their deposit and then think what to do next. So the best thing is go through all these necessary steps, prepare yourself, decide how, when, where, what, and then analyze everything, see all the events, and then make your trading decision. But back to the subject, we have two major directions, bullish and bearish market. You need to know this, not to confuse them, to think that bear is up and bull down. It's bullish and bearish, and it is important to know. So Forex market, basically we need to see to come lower to the lower levels, which is retail Forex trading. Nowadays actually is very popular, and as I said, it's one of the fastest growing industries, as there is a number of financial brokers in the world that provide the services to the traders, including the trading platform, price feed, all type of analysis, comments, calendars. So it's makes you ready in a way from their side. So provide you all necessary information that you need, and it's now your job to start applying these things, of course, with the things that we mentioned previously. And how the brokers work, they provide you something that they charge you sort of commission for their services. But most of brokers are trying to work without commission, trying to attract more traders, saying that we don't charge commission except certain instruments that are we get the prices from exchange, and exchange itself charges you. You cannot get it free of charge, so you need to cover partially. But main income of brokers is basically in the price difference, so they're trying to catch one small part of the trading pip, and they make their commission, they make their profits actually on this. This is so-called spread. So who are the Forex traders? They are us, me and you, and the so-called retail traders. We do not fall in the group of professional big traders such as banks, central banks, or funds or governments. But we belong to the biggest population, because the number of retail traders is far bigger than the number of institutional traders, so-called. That is the group that I mentioned. And of course, that due attention is given to this huge market, because most of the price providers, service providers live from this. You cannot, as a smaller broker, you cannot have a bank or a big institutional investor as your trading client. This is quite difficult to catch, but you have a number of small retail traders who are giving much smaller amounts, but can last for some time, of course, if they are directed properly, if they follow the market, if they don't gamble, if they don't play with this. So let's talk again a bit about market movements, about exchange rates. I want you to understand well how it works. So let's try with the sterling against, wow, this is 1 second. Let's talk about sterling against US dollar. I'm going to put a nice chart without too much technical indicators, so it will be easier to follow. So what one trader needs to know is the trend. Now we have a strong move to the downside, apart that all these indicators are pointing lower, so it's quite clear. All fundamentals are working in favor. So if we jump, let's say, and sell it now, 126.43, and we close our trade at 126. Let's say we come at sell it at 126.50, and we come at 126.00. So we estimate that market may go further down. So let's just take a look how it is. This is the lowest of 2019, this spike here, and it's at 123.9, so it's quite far, but the market is tending to go towards there because all the situation is working in favor of such a move, unless something happens meantime. So if you catch, let's say, 50 pips, then each move from one to the other tick, from 126.50, let's say, to 126.49 is called one pip or one tick. And let's say it has $10 value. So you get base currency, which is British pound, and you have the second currency, which is US dollar, and your profit loss will be expressed in the US dollars. So let's say if you quote 50 pips, your profit will be 50 times 10. $10 will be $500. Sounds good. So you learn how it is separated, how it's divided, about the pips, what's the pip value, and how it is working. The other advantage of Forex trading is its volatility. So we can see that the market is very liquid and it's moving, even if the downtrend is taking a breath or taking pause, because when you take a look at the daily chart, there is a steep descent, all in red. But if we go back to 1 hour or even 30-minute chart, then we can see that market fluctuates up and down, corrects a bit before it goes. There is nothing that could make sudden move at the moment. So market is fluctuating. Some traders will be taking profits. Some are thinking, let's take a look. The market is very oversold and is turning higher. Stochastic RSI still oversold, so will be some correction. I mentioned this in past 2-3 technical comments during today, yesterday, and day before, saying that there is a possibility of correction signaled by technical indicators, nothing else. But this also needs to consider that some traders will take profits, because when they see certain long move, let's say if I entered here, I would take my profit and I will wait for the next opportunity to re-enter, because at certain point you need to book to confirm this profit. Everything else is floating. So if you are in the floating profit loss, you are not going to get this money, and you have it at risk. It may increase further if the sterling goes down, but something may happen, so the sterling will jump 200 pips up, and then I will lose biggest part of my profit. So I'm going to take it. So I have to buy. And there are a number of traders like this who are buying at this point just to book the profit, and they're waiting for some corrective action a bit higher to re-enter market and catch the further move down, as overall picture is negative, sentiment is negative. So we are looking for further advantage, further descent of the market to catch some more profit. Now there are a number of different traders in the forex market that depending. Now again, we spoke about this. I think I mentioned in the previous classes. Small trader must respect the market, because when you have $1,000, $2,000, or $10,000 even, you are a small trader. And when the big institutional traders come with hundreds of millions, they are sharks. So you have to adjust yourself accordingly, not to do something that your account cannot stand, so not to gamble. So you have to, what we said, respect the market. This is very important because it's a huge machine that can mince you within a second if you are not careful, if you don't behave as according to the size of your trading account. You have to adjust your needs and your plans according to the size of your account. So you cannot act as a fund, let's say, who comes with 300 million and you have $2,000 in the account. There is a much higher risk for you to be wiped out from the market than a fund or a big bank or something. They may catch wrong move. They may have problems. They may have some losses, but their traders, their dealers will jump out of this position that is not good and wait for another opportunity. And this will show a minimum loss on their few hundred million account. But when you do such mistakes, then it means you are close to the end, or you completely wipe out your account. And this is the thing that we are trying to avoid. Now, the other thing, I think we mentioned already, brokers offer the leverage, so they give you some sort of credit. And we already spoke about this in previous classes, so I'm not going to elaborate more about this, but always you can ask the question, and if there is something that we have missed or we didn't say it clearly. Just to recap today's session, it is the biggest market in the world, was $7 trillion US daily turnover, says everything. Very liquid, very interesting, and that's why the Forex industry, especially retail trading, is booming in past decade or so. And there are some rules that are coming recently that are trying to put it more in order, I would say, not to stop it. So there'll be more regulation which is in favor of traders, not in favor of brokers, of course. But interesting thing is that this is quite adventurous, and I would say, and very interesting way to try to make money. What is something that I forgot to mention to you? As you can see, we mentioned the major currency pairs. We mentioned the cross rates, and they have their sort of nicknames. So let's say if you have currency pair euro US dollar, it's usually called in the industry euro. So it means, when you say euro, it means euro dollar. If it's a dollar against Japanese yen, it's a dollar yen. So give me a quotation for dollar yen. And this is how it works. British pound against US dollar has the name cable. This comes from many years ago, when there was a cable passed over Atlantic between the London and New York, and all the communication was going through this cable when we didn't have this advanced technology, so it stayed cable. Swiss dollar against Swiss franc is called the Swissy. So when you hear a Swissy, it means quotation for current price of US dollar against Swiss franc. Then we have dollar against Canadian dollar. Canadian dollar is called also loonie, from the coin of the 1 Canadian dollar, and usually brokers quote it as a dollar Canada. And so when you hear dollar Canada, it means US dollar against Canadian dollar. Both are dollars, so you have to specify always what do you want. In this case, if you have euro dollar, then it's two different currencies, but you have $2. You need to specify which one is your base currency. In this case, it's a US dollar. Then Australian dollar is called Aussie dollar, and New Zealand dollar is called the Kiwi dollar. So you can hear this. I use these nicknames and wording a lot in my comments, and You can read it in my comments. Aussie dollar stands there. Cable is lower this morning, again under pressure. So these are the terms that you need to know to feel more comfortable, not to get confused all of a sudden when you decide to make a trade and the broker is coming back to you and says Kiwi rate is this, and you don't know what's he talking about, which happens to all of us. I mean, it's not something that is new. What else is important to mention? How it works. We have, as said, we have base currency, which is the first one, and the quote currency is the second one. And now the price that comes, it's called bid and ask. So you have the first price and the second price that broker gives you. So if you want to trade, you will get two prices. So for example, sterling at the moment is trading at 126. Let's take a look. Let me just put you the screen of sterling against the US dollar. We put 1 minute chart so we can see almost all moves. So 126, 56, 57 at the moment. So you will get 126.574 or 126.50. 800. So we have on the fifth decimal we have 0.6 spread. So this is called the spread. The first price, it's called bid. So if you have 126, let's make it easier, 126.50 and 126.51. The first price is bid. It's called bid, which your broker will buy the currency from you and you are going to sell. The next price, which is slightly higher, it's called ask. And this is a price where you buy and your broker sells. So you have two prices, bid and ask, and you can see how the market is fluctuating. So sometimes it's quite difficult to catch. Trading platforms nowadays have, when you ask for a certain currency pair, they give you a live price, so it keeps moving. So when you decide it's the best price, you just click execute, and then you get your execution at the price you want. Spreads are quite narrow. I must mention this because in order to stay competitive, you have to have very narrow spreads, and bid and ask are coming as the industry grows. Bid and ask are coming closer to each other compared to the time I remember some 20 years ago when the spread was a regular 10 pips. So if you want to buy sterling against US dollar, you will get the price 146.50, 60. So it's up to you. Some cross rates had even wider spreads. I remember Japanese British pound against Japanese yen had some 15 pips spread, and that was normal. But we're talking about a time many years ago when the things were different, when the trading was executed over the phone, when the reports were written on the paper and the price actions, price feeds were delivered through Excel sheet. Now we're talking about something else completely. This is nowadays space technology, and much life for brokers and for traders, much easier. A lot of advantages from this technology. It gives opportunity for traders to quickly execute their trade with the best possible price, the price they wanted. This is quite normal when you have 1/4 of pip spread compared to 10 pip spread. 10 pips times $10 means it's $100, so 50 on one side, 50 on the other side. And that was at that time, that was a good income for brokers, bigger institutional brokers. With that time, small brokers, retail brokers like nowadays, basically did not exist. We just had a number of big institutional brokers that were providing prices, and it's up to you to take it or leave it. They give you a quote over the phone. If you hesitate, they will just out it and say price changed, get another one. So things have changed much. They become much more advanced, much better for ordinary institutional traders, making their lives easier. and the opportunities to make money are quite better because you have a narrowed spread, you have more competitive prices, you have fast service, which means that you catch the real price. There is no over the phone delay in everything. It's done instantly, and then you can quickly come out if you are not happy, or catch the next price if you catch the move and make the profit. And just few things at the end to mention. We spoke about this, but it's also important to mention. As a trader, you need to know what are the main factors that influence the price action. So what we have, offer and demand. Offer and demand are influenced by other important factors. We're talking about economical situation of each country, political situation. A good sample now is political turmoil in Great Britain that pushed sterling greatly lower. So all these factors are very important. Then the monetary policy. Nowadays, we are still facing that the major world central banks have ultra low interest rates. This is since the crisis broke out 2008 in States. And since then, all the central banks were trying to do the best possible steps to save themselves and economies from total collapse, because when you have economic crisis, recession, then the things can quickly accelerate to the wrong direction if you don't control them. It seems that most of the central banks, world central banks, did a good job and managed to pass the difficult period with the minimum damage. But monetary policy is also one of the key factors that influences the market, and if their words, if there are, let's say, hawkish comments that certain central bank will start tightening or increasing interest rates, that currency of that country will start increasing, or vice versa. If there is dovish tone, like it was recently last week from Australian Central Bank, saying that due to current situation and the lower and the worsening situation in the labor market, they are thinking of decreasing, lowering interest rates likely in June or possibly in July if June is not, but they're talking about this. So in this case, this will be pushing the currency lower. Now we have currency interventions also. They're very important. A few happened during the last night in Asian session when the South Korea's central bank intervened, and a number of other central banks, I think Hong Kong and Indonesia also, as currencies of the Far East countries were significantly lower during the Asian session today on Thursday, and then central banks intervened in order to support them to prevent collapse. So these things are also important and have strong influence on the market. And we have events that are unexpected, unwanted, but they happen. We have terrorist attacks, we have natural disasters, we have things that sometimes cannot be controlled. We have good sample September 11, we have good sample of some big earthquakes, tsunamis and things. These are the things that also have strong influence in the market, and they need to be considered in order to prevent or minimize any potential losses, because in such a case, once you make loss, then it's a problem to return back, and then you need to review all your strategy and things that we already talk. So it's the best to prevent rather than have a problem later on. And this will be all from today's class.